So in this session, it's really about making the business case for carbon markets, honestly understanding where the gaps are and how to effectively scale the voluntary carbon markets. And like I said, we have very heavy-hitting panelists, so please put your hands together. We have Miss Herry, the Managing Director and Head of Sustainability and Sustainable Finance at Singapore Exchange. Thank you for your time this morning. We have Mr. Piyush Gupta, the CEO of DBS Group. Wonderful to see you again. Welcome. We have Mr. Sunny Verghese, the co-founder and group CEO of Olam International with us. Good morning. And moderating this discussion, we are in very, very good hands. We have the director of the investment group at Temasek, Mr. Sebastien Pascual. Thank you very much. We also have a gentleman joining us online for this discussion, and he is none other than Mr. Bill Winters. He is the Group Chief Executive at Standard Chartered Bank. He had an illustrious career with JP Morgan before that. I think he's one of the top 5 executives there at the time. And now he's the chair of the task force for scaling voluntary carbon markets. So we'd love to hear his take on the topic.
We know we are at a global crossroad right now. We know we need to keep global temperature change below 1.5 degrees centigrade. We know we need to transition to net zero greenhouse gas emissions by 2050. And we know we need to make material progress between now and then, in particular over the next 10 years, to have an effective outcome to this massive climate program on which we're all focused. And we know how to get there as well. We've got a pretty good idea about what the component pieces are. One is we all need to reduce our emissions in every way that we can, individually, as businesses and corporations, and as a public sector. We know that we need to protect our existing carbon sinks. We know we need to develop new carbon sinks. And we know we need to make investments in the technologies that will allow us to both remove and permanently sequester carbon and greenhouse gas emissions for some time to come. We know all that. Very easy to say, not so easy to do. We also know that it takes a tremendous amount of effort and money. So how are we doing in that regard? I actually think we've made a tremendous amount of progress in the past couple of years, and it's accelerating. First and foremost, we see governments and businesses and individuals in some cases around the world making net zero commitments. We're all focusing on what the baseline for data is, right? Absolutely critical that we get the data right from the outset, and then we track that. We know that data needs to be translated into a firm set of commitments with very specific transition plans that will affect many of the businesses that we operate and obviously affect many of our lives directly. And we know that this all can lead to changes in real underlying behavior. Now, beyond the outright focus on reduction, the voluntary carbon markets have a critical role to play in this regard. Why? Well, one, they can help move billions of dollars of funding from the pockets of people like Standard Chartered Bank and others who are making net zero commitments into the hands of people who have the opportunity to actually reduce greenhouse gas emissions in the environment. Second, we know the voluntary carbon markets, done properly, can provide a high confidence, high integrity way with a high degree of visibility to provide a price for carbon. And that price, beyond the price at which carbon credits are exchanged, which of course is very important in and of itself, also gives a key component to corporate and public sector decision making, which will allow the kinds of trade-off decisions that we need to make every single day between investing in one type of technology versus another, one type of process versus another, etc. So the voluntary carbon market, as we see it, has an absolutely critical role to play. Now, it's always going to be a secondary role to the primary focus of reducing the carbon intensity of our economy in every possible way. But it's an extremely important incremental tool, both to get that money flowing, to provide that transparency. Now, we know that the market for voluntary carbon credits has been very uneven. It's been characterized, it's been around for a long time. I've been involved with it for probably 20 years myself. And we know that the market has been characterized by uneven standards. There's a lack of confidence in the integrity of some of the credits that have been originated. There's a lack of transparency. There's a lack of visibility. And we see that manifest in a number of different ways, not least the price. Ask them the price of carbon, and you could get a price ranging from $1 a ton to to $60 a ton, and pretty much everything in between. This undermines the confidence for those of us that are both seeking to use the market, but also looking to reference the market and looking to find the structural solution. So one of the key opportunities from here is to take this critically and very important and essential tool, which is a marketplace to allow for the transfer of value based on the price of carbon, to operate in a much more smooth and effective manner. And if we can do that while combining with a much clearer focus on what it means for a corporation or a business or a country to be net zero, what does that claim actually mean? So we've got really two bodies of work that are going on right now, one around the voluntary carbon markets and one around the integrity of corporate claims. These two things work hand in hand together, and I think to the extent that we can bring these all together, I think that we can, we have a pretty good chance of actually solving this vexing problem in the years to come. Now, I've been chairing something called the Task Force for Scaling Voluntary Carbon Markets for the past year or so. This group of 350 plus members who have come together representing buyers, sellers, intermediaries, NGOs, academics, really the full range of the carbon community, have set about establishing, number one, a set of core carbon principles to which we can all subscribe, that we can recognize is a high integrity, high confidence level of actual carbon removal, but also to put a governance process in place so that those principles can be overseen and curated, adjudicated over time, and that the associated market infrastructure that can help support the voluntary carbon market is done in a way that has the greatest possible chance of success. This is a private sector initiative. It's a coming together of various participants in the market, but it complements and goes hand in hand with many of the public sector initiatives as well. And this is something that no doubt will be fleshed out in the days and weeks to come. The recommendations that we've come from with this Task Force for Scaling Voluntary Carbon Markets are quite robust. So we set, in an extensive report that we issued back in July, a very detailed listing of what we would consider to be core carbon principles. So the criteria around additionality, around transparency, around the verification and measuring that would be necessary to build confidence in the core carbon principles, which would lead to core carbon contracts. And the governance process that we put in place around a board of directors is equally robust. So we are in the final process of putting that governance body in place. We'll have a board of directors, which will have a majority of independent members, i.e. people who have no economic stake in the market for carbon credits, but who are nevertheless very familiar with or experts in these markets. There will be market participants that are involved in that board to make sure that the body is well informed. And they'll be advised by a council of experts, an expert panel with dedicated staffing. And they'll be supported by an executive secretariat host. So the idea is to have a very robust governance framework to support a very robust set of underlying core carbon principles. And to do that in a way that allows the market to continue to thrive and grow over time. If we're successful, we think that we will be, we'll take what today is quite a fragmented market that cuts across geographies and project types and buyers and seller types, and create an element of consistency and coherence to this market with a high level of integrity and a high level of transparency that will have the effect of creating that large and sustainable and evolving and growing market without any compromise in quality at all. And this will allow those eventually hundreds of billions of dollars to swing from the hands of people who are making our net zero commitments into the hands of people that can actually get the carbon out of the environment. Thanks very much.
Good morning, and thank you for being here in person. It's probably one of the few mostly in-person panels we have today and this week, so it's much appreciated. Unfortunately, Bill couldn't join, but I think his remarks are a very good introduction to the topic of the voluntary carbon market. And he hinted a little bit at some of the difficulties faced by corporate. And maybe we can start with you as our first panelist, Sonny Verghese. Sonny, you are the CEO of Olam, and it's one of the largest agricultural trader and processor. You're also the chairman of the World Business Council on Sustainable Development, and you've been resolutely steering the company towards more sustainable goals. Can you share with us some of your journey on how, between quantifying your carbon footprint, setting up public targets, and what are the implications of meeting those targets, and what role has carbon credit to play in all this?
Yeah, thank you, Sebastien. I think the first thing to understand is greenhouse gas intensity is very idiosyncratic and specific to sectors. As a leading global food and agribusiness, this sector has very high greenhouse gas emission intensity. So we account for roughly 25% of the world's greenhouse gas emissions as a sector. But if you add land use change and food waste and loss, that's another 8%. So the global agricultural sector accounts for between 30 and 31% of the world's greenhouse gas emissions. As a consequence, being a leading global food and agribusiness, we have a high carbon footprint. In 2020, our total greenhouse gas footprint across scope 1, 2, and 3 was roughly 78 million tons. 95% of this is scope 3 emissions, and only 5% is scope 1 and 2. The first major challenge that we face as companies, and as chair of the WBCSD and other climate organizations, I have spoken to at least 250 CEOs, all of whom have signed and committed to the science-based targets of the 1.5 degree pathway and to get to net zero by 2050. And I can tell you that not one of us have a clue of how we are going to get there, right? We have all put out these commitments of what we will do in 2030 and 2050, but the granularity of the pathways and how we are going to get there is extremely flimsy, and really does not give us the confidence that we can really see through those commitments. So the first thing that is issue is that carbon measurement is not trusted and not robust. Today, typically, all of us as companies measure our carbon footprint through a life cycle analysis methodology. And it is a complex methodology. It takes time, and it is not very accurate. And the confidence level of, if you appoint 2 consultants to do a LCA analysis and carbon footprint measurement for your company, the 2 will come up with very different results. So I think the first thing that we need to do is to have a robust measurement system. And I don't think the current technologies that we have, or the current methodologies that we have, or the approaches that we use can really provide us that assurance that the measurement is accurate. And therefore, in order to make it more accurate, more quicker, more affordable, we need to have a technology-first solution. And that is why at Olam, after 9 years of measuring carbon using life cycle analysis, we have now shifted to a technology-first solution, which was born along with the AFA on sustainability, which Piyush and I was part of. And now we are trying to take this out as an industry solution. It is not sector-specific. It is not just for the food and agribusiness. It is for all sectors. We have established the proof of concept of whether this works in terms of curing for all the complexity and issues that we currently have in carbon measurement. And we have tested it in Olam because we have a very large footprint. And the big surprise for us was, against our baseline of 78 million tons of greenhouse gas emissions in 2020, this new measurement system that we're using now, where we have a much higher degree of confidence, is shown that we have 91.8 million tons. Again, so that is a 34% increase in our baseline assumption of what our carbon emissions is. And our goal is to reduce our carbon footprint by 50% by 2030, and we already are now knowing that we are already 34% behind. And if our business is growing at 10% CAGR, which means every 7.5 years we are going to double the size of our business, then we are going to have increased carbon intensity, and now from a larger base. So the second thing is really about having a system that can track the key abatement levers and simulate, and therefore allow you to develop a climate action playbook. Because the idea is not just measuring. Measuring is just the first step. The real deal is if you can actually help decarbonize your company and get to net zero, and what are the pathways for doing it. So these abatement levers looks at the hotspots of where your emissions are, and looks at a cost-benefit analysis of which are the levers that you can pull, abatement levers that you can pull, and what will be the cost, and what will be the effectiveness, and what will be the impact. So that is the second thing. The third thing is all about the supply chain. If you're a good player in your industry, it means nothing because you're a tiny, tiny cog in the wheel. So the third piece is how do you partner with your supply chain, your suppliers and others, to really system change the food and agricultural system like the one that we participate in or other sectors to achieve that. And finally, it is about verification and reporting and engaging both your internal stakeholders in terms of your employees, for which the measurement system has to be verifiable by third-party assurance companies. And then you can communicate with investors, your employees, your customers, your suppliers, your regulators with a more high confidence level measurement, monitoring, management system.
Thank you.
If I can
Please
come in and add 2 more levels of complexity to Sunny's comments. I agree with everything Sunny said. But the first relates to my sector. In banking, since we deal with every sector, our scope 3 emissions include the emissions of every sector. And therefore, the complexity of trying to figure carbon footprint of food and agriculture, I've got to do that sector by sector. I've got to get the same degree of transparency for steel, aviation, transportation, real estate, property, everything. And this lack of methodology, lack of a good set of tools, means it's extraordinarily difficult for me to try and figure out what my scope 3 is. In fact, I sometimes say, we're at the tail end. I've got to get everybody to measure their carbon emissions, and then I get a point of view of what is the financial sector scope 3 emissions. So very complicated. The other complication really comes to what Sunny talked about is abatement methodologies or transition pathways. I think there's a lack of global clarity of what are acceptable transition pathways. Of course, transition pathways also hundreds of them, and depending on who you talk to and how you look at it, you could choose one of 100 different transition pathways to get from where you are today to your 2030 goal or 2050 goal. Just to make it simple, I mean, you take something like coal. So if you move from dirty coal to clean coal, or if you move from clean coal to gas, if you move from gas to something else, is that an acceptable transition pathway or not? And depending on the macro politics, depending on if you're sitting in Australia or sitting in Germany, depending on the socio-political realities, the acceptable transition pathways are very varied. Now, when we work through this, we've got to define both the taxonomy of transition pathways, but also the acceptability of these transition pathways. And that's a big judgment call. We published our own taxonomy last year on transition, and it's sort of aligned to the European taxonomy, but there are a lot of differences because I operate in Indonesia, we operate in India, we operate in China. I have to take into account what is the reality of the situation on the ground. So acceptable transition pathways are not easy to understand and easy to define. And making sure that your own commitments are aligned to those is therefore even more complex.
No, thank you. I mean, we see it's a very complex process to actually quantify, abate, and account for this. And maybe it's a good segue into our third panelist, Herry Cho. So, Herry, you head sustainability and sustainable finance at the SGX, and you bring a wealth of experience in green finance, having been one of the pioneers of green bonds in Asia Pacific. Given that SGX is a frontline regulator as well as an exchange, I mean, what do you see in terms of those difficulties of corporate commitment? Do you see listed companies moving massively into reporting? And what are the do and don't in terms of outlining an acceptable path toward decarbonization?
Yeah, thanks, Sebastien. So let me start off by saying that everything that Piyush and Sunny said honestly keeps me up at night. Pretty much every night, because, and you feel so humbled, even though you're breathing and living sustainability every day as someone who has a role to move sustainability and sustainable finance, because you realize it is a seismic shift that no one party can do alone. And that's exactly the point that's being made here. Now, just on the point that Piyush was saying on the varying transition pathways, well, if you look at the Paris Agreement itself from COP21, the net zero that we have to get to, that is actually supposed to be a global average. And it is actually written in the Paris Agreement that the developed nations may move faster than some of the developing nations because they have the resources to do so, and they're potentially at different stages of decarbonization pathway or overall emissions. So with all of that, but with a drive towards how do you come to some level of interoperability, the way that Dr. Marjun said, or some level of harmonization in definitions. That's the real challenge. So I would like to emphasize before deep diving into companies, that linkage between what governments are putting down as a pact and what financiers are doing, and ultimately what we need to see in the real economy, in the actual absolute decarbonization. These are absolutely connected points. Now, but still, can corporates do something? Can companies, should they be playing their part? Absolutely, and that is at the largest listed entities to SMEs as well. Now, what we're seeing is, depending on the market that you're looking at, companies have clearly woken up to this agenda and deploying resources into the transition that needs to happen. And that means gaining knowledge, whether that be increasing your own knowledge and capacity within the firm. You know, I've heard from a headhunter, the hottest job recruitment right now is in sustainable investing across the board. Or, you know, working with independent experts out there. But I couldn't agree more with the point that Mr. Larry Fink made earlier today, that, you know, that knowledge building inside the firms are very important, and that is starting to happen. Now, in terms of credible pathways, what's really important is that this language, it's a very complex language. In many ways, there's so many acronyms, it can be archaic, so it has to be translatable for leaders around here to be able to implement and spearhead that and drive and build capacity. So that's also why we, earlier this year, published a short white paper called Credible Decarbonization and Transition for Corporates in Asia for easy consumption. And there are a few components to it. Number one, of course, it goes without saying that you have to know where you're starting. So scope 1, 2, and 3, where are you at today? You have to measure that, and you have to measure the best of the international standards out there. And they do exist, and they will continue to improve, but they are out there. Secondly, then you have to have a clear view, and this is a board level, this is a management team level decision that needs to be made. Where do you want to go? What are your stakeholders saying? What's material to your business? You have to look at it from both the opportunities perspective, but also what are you going to be missing out on if you don't do something today? So you must future-proof your business. So from that perspective, you know, where is it that your company is to go? And of course, we start with decarbonization and carbon footprint, but of course, it's not only carbon footprint. There are many other environmental and social objectives. So once you've set that pathway, ideally aligned to science, that's when you start to actually undertake and look at the projects that you should be undertaking to make that happen. And, you know, as Bill said as well, absolute emissions reduction is first. Easier said than done, right? So these are all part of that high-level corporate strategic direction and thinking that the leaders in this room must actually spearhead and drive within their firms. And, you know, as you look at that hard slog of trying to do that decarbonization of absolute emissions reduction, you will still have ongoing emissions. So that's when, as Bill had mentioned, carbon credits can come in, whether it be compliance or voluntary carbon credits, they will come in, right? So there's been interest in the markets, and this is where I think I will touch upon greenwashing a little bit. Now, if companies don't have that broader perspective of what is a credible pathway, then it's actually very easy to do greenwashing without even realizing they're greenwashing. So, you know what this, I'm describing what's called carbon mitigation hierarchy in the highest level sense. Understand what that is, and even when you look at carbon credits, there are many different types of carbon credits. You know, what should be looking at, what should you be looking at first? What can be contributed towards your overall broader strategic decarbonization plan? So these are all very important components. And just final component to that, disclosure. You have to say what you do and do what you say, because everyone's watching what you're doing, and that's very much the part of not greenwashing. So disclose, be transparent. You know, people are future looking. You know, even if you are not quite there yet, people understand that. So step by step with transparency is key.
Thank you, Herry.
So if I push back on one comment you made, Herry, I'm sort of more in Sunny's camp. When you said the standards are there, and you should be able to start disclosing, including scope 3. I think there are 100 different standards. There is no one. I think there's an alphabet soup of different measures, and there is no clarity of what is the right way to do it. Sunny talked about 2 different consultants coming up with 2 different measures. I will tell you, in my own firm, my people produce a report saying this is our scope 3. In 40 minutes, I tear it to shreds because all the assumptions, I can blow a hole into every one of them. So I think unless we really get down to a methodology, either technology-driven or otherwise, we will be boiling the ocean without really credible measures. So the consultant paper, what SGX rolled out recently, which said, should we report X, Y, Z? Of course, we should try and report everything we want. But unless we solve the problem of accuracy or reasonable accuracy of what we want to report, we will be doing a lot of work with no clarity about is this the right thing to measure, are the measures right, and how do we take it from there. So I do think there is, I wouldn't jump to saying the standards are there, we can all start reporting. I think there's a lot of work to be done.
I agree.
Thank you. I mean, once you've managed to account for this, I mean, I think the interesting part is how you channel the finance towards making decarbonization happen. And maybe, I mean, Piyush, you are at the helm of DBS, that you've contributed to make one of the leading financial institutions in Asia. You have a sustainability finance target of 50 billion. You're also phasing out of some of the dirtier type of industries. Practically speaking, what do, you and your peers, to build the ecosystem and the market infrastructure?
Well, so there are 2 parts to this. I'm going to talk first about what we do as a bank. We basically broke our thinking in very simply into what we should do more of and what we should do less of. The new business ecosystem that we're all trying to create, I think will be a $1 trillion opportunity. New green buildings, new hydrogen fuel, new ways of transportation, new food and agri systems, etc. As you think about the next 10, 15 years, each one of these will require a substantial amount of financing and substantial amount of incremental capital. So therefore, that's an obvious one. How do you find the new opportunities to finance? Increasingly, our book around renewable finance, wind, solar, power, electric vehicles, etc., is one of the fastest growing parts of our book. So that's one part of things that you can look and say, how do you build a business strategy around capitalizing on this $1 trillion opportunity which is going to come on us. The second area, which is a little bit more difficult when you think about doing more, is this transition finance. That becomes more tricky for the reasons I mentioned earlier, because then you're going to start working with companies and sectors on agreeing on what is an acceptable transition pathway. So if I finance you to do X, Y, Z, this is not entirely green, but it's a step in the right direction. And if I can see that you're headed in the right direction, I can measure it, I will finance it. So, but that you've got to be a lot more nuanced and thoughtful, understand what Herry said. What is the agenda of the company, and is it a one-off or is it directionally the same way? But that's the second big thing. Our focus on these things, the actual sustainable new businesses is quite large. The third thing we do though, we've done one with Sunny and Olam, we work with companies and we essentially offer them subsidized rates. If they can tell us this is our ESG agenda and this is how we're going to reduce our climate or our carbon footprint over time, and if I can go and work with third-party auditors to make sure they're achieving it, I'll reduce your rate of interest. I call that a sustainability-linked loan. So it's actually a current business, but I work with you to make sure that you're trying to do something good. I sometimes joke with Sunny that I don't get cheaper capital. I just do this because I think it's something we can do to move people in the right direction. So as you correctly pointed out, Sebastien, we had set up a target of some $20-odd billion of the sustainable finance for 2024. But the pace of growth of this has been so rapid, we've hiked the target up to 50 billion across all categories that we just described. The second part we do is what we do less of. And what we do less of is quite clearly we've got a sector view. The sector view is informed, frankly, not just by climate issues or the morality ethics or 1.5 degree. It is informed equally by risk. So we're very concerned about being in sectors and industries where we're going to wind up with long-tail stranded assets. If I do a thermal coal project today with a 20, 25-year loan, there's a high likelihood that in 10 years from now, those assets will be worth nothing. So it's not sensible for me to take on that kind of stranded asset risk. So the risk prism causes me to actually shrink my financing in some sectors, but also actually the carbon emission prism. As I'm trying to shift my portfolio to a lower carbon intensity portfolio. So we've identified sectors, we've identified companies in those sectors, and we're quite clear with some companies. Some companies we exited. In thermal coal, we exited thermal coal projects, we exited companies with thermal coal mining. We're actively looking at scaling down, and by 2025, we'll exit companies who have more than 25% reliance on coal as a revenue source in aggregate. So we're trying to see what we can do less of by sector, if you will.
Can I just add one thing? I think in all the conferences that I attend, the focus is always on the why and the what. Why do we need to change? What is our aspiration in terms of the objectives and targets that we are setting for ourselves, whether it's net zero or whatever else it is. Last week was all about the UN week, and there are, almost every second day there was a conference of some kind related to climate and the environment. In none of these meetings is there sufficient focus on how. And what CEOs and businesses are struggling with is granular pathways in terms of a climate action playbook that will actually allow them to reduce the carbon footprint by 50% or 75%. 50% or 100% by 2030 and 2050. And as Piyush said, the why is clear to everybody. He's talked about how much green financing or sustainability-linked loans DBS provides. We ourselves, since 2018, which was the first year that we issued sustainability-linked loans, we have raised about 3.7 billion between 2018 and 2021 on sustainability-linked financing. And we know the cost of that is cheaper. We know that our investors ascribe a lower cost of equity for companies that are more sustainable. So if you're ranked high on sustainability, the same future streams of cash flow are discounted to your present value at a lower cost of capital. So we all understand that. But very few of us really are able to have granular pathways on how we can decarbonize. So the focus has to be, how do we decarbonize? That is what industry needs, private sector needs, and everybody else really needs in terms of solutions.
Thank you.
I can just take 2 minutes more.
Please.
So apart from at a bilateral level, I think, Bill pointed out, this $100 billion of finance which needs to flow from developed countries to developing countries every year is not been flowing. The real opportunity, I believe, is to actually get the private sector to fund many of these sequestration and decarbonization projects, many of which are in developing markets, many of which are natural climate solutions, nature-based solutions. So one of the things that we did from the Alliance for Action, the Emerging Stronger Task Force Sanya and I were on, is evolve this construct of seeing if we can create a voluntary carbon market exchange and see if we can create that exchange in Singapore, right in the center of Southeast Asia, a lot of natural resources, food, agriculture, etc. on the one side, but be and leverage on Singapore's position as a trusted entity, good infrastructure, good financial infrastructure, the issue of trust. Bill talked about the fact that the voluntary carbon markets have not grown in the last 25 years since the Kyoto Protocol, principally because of lack of transparency, reliability, verification. And so our agenda was effectively, if we can solve for some of the problems, create a structure where you can get a verification process, a ratings process, a good quality bar, hit all of the attributes of the Task Force of Voluntary Carbon Markets, and ensure a nature of supply. We can make the supply available for price transparency, either in an auction market or in a secondary exchange market, and use this availability of good quality, high bar supply to bring in all of the carbon credit buyers, the 1,800 companies which in the last year have made net zero commitments and are all committed to buying some of this. Bring them on a common platform to promote price discovery and liquidity. We think there can be a big opportunity to solve this financing gap and financing issue. So that kind of infrastructure, I think, needs to come into place. I think what we're doing with CIX in Singapore has got a good shot at providing an infrastructure of that sort.
Oh, thank you. I think we should take a few questions from the audience. We have a couple of interesting ones that are popping up, and maybe we can use that one to start with. From Steve Meloish of Planet Rise. I'll modify it a little bit. I mean, it's basically talking about how do we ensure that higher value carbon credits reach and protect the natural carbon sink. And I'll broaden that a little bit and ask you, are all of those carbon credits equal to you as a corporate or as an exchange or in terms of sustainability reporting? Do you value some more than others? Is it better to have a natural-based solution, protect the ecosystem, or is it better to abate fuel switching cost, for instance, or help the renewable energy scale up?
The fact that we have carbon prices, which are a very broad range of prices, from $5 to as much as $100, shows that every carbon credit is not equal. So they are different based on the quality of those credits and based on whether there are co-benefits attributed to that value or not. And the issue is really, the constraint is really the supply of good quality carbon credits in terms of investment in conservation assets. There is very, very little or limited investment in conservation assets. When CIX was being set up, and Piyush and I committed to Piyush and Mikhail that Olam will supply some of our certified carbon credits to that platform to just generate the volume and activity in that platform. But after we did Green Pass and established what our own requirements for carbon credits are, we suddenly discovered that across all our landscapes, our forestry landscapes, our high conservation value set-asides, which are all very high quality carbon credits, they're not even going to account for 28% of what Olam needs after our mitigation and abatement to set off. Right? So suddenly I've discovered that it is not going to be enough. And we have got probably some of the richest, for a company of our size, some of the richest conservation assets. So investing in conservation assets and increasing the quality of conservation assets that can produce the carbon credits that can scale up a voluntary carbon credit market is critical.
Sebastien, I guess the two parts of the question. First is, I think it's well known that natural climate solutions, nature-based solutions, today are the single biggest possible source of carbon credits. 31 or 33% of all potential carbon credits come from there, as opposed to industrial or renewable energy or the other forms of credits that you spoke of. So it's a big supply possibility. Which means that if you focus on that, you will get large, chunky availability of carbon credits. Also, where we are located in our part of the world, Indonesia in particular, but Southeast Asia, some parts of India, mangroves, water, forests, etc., the availability of supply is actually very real. So that gives you a natural incentive to look at credits supplied from that area. How do you make sure that the credits actually, the money goes into the right projects? That's the trick that we talked about, that you need to have a process of project selection, which is robust and stands scrutiny, which gives you and will make sure that your bar is high, that it achieves all of the carbon principles that were set up. So it is incremental. It's not something that would have been done anyway. It's additional. It is permanent. It's not like you grow a tree which is going to be cut down in 3 years' time. That it actually sequesters what it's supposed to sequester. And by the way, potentially it delivers co-benefits, biodiversity co-benefits, social co-benefits, etc. That work needs to be done project by project. And one of the things that CIX that we're trying to put in an infrastructure to do that work, supported not just by today's verification agency, where our gold standard, put a rating on top of that, but use technology. So satellite monitoring and sensor systems, maybe LIDAR and acoustic technology, to make sure you can guarantee that the tree is where the tree is supposed to be. The forest is grown where the forest is supposed to grow. If you can layer this kind of technologies, you'll make sure that the money is going to the right kinds of projects. The other thing that we're experimenting on, in fact, we ran a global accelerator. We have 300 companies, including Google, Microsoft, etc., is not just to look at the verification technologies, but blockchain solutions to make sure that the benefits are actually going to the farmer or to the plantation person, the estate person, and they're not being sort of siphoned away on the side. So you can if you leverage technology, you should be able to do a better job of making sure that the money is going to the right projects, to the right carbon capture sinks, and to the right people.
Just to add to that, there's references of CIX. Maybe I'll just briefly explain what that is. It stands for Climate Impact X. It is a carbon exchange, a marketplace that is to be set up later this year and early next year. And the focus, indeed, very much so, it's on high-quality carbon credits, and so definitions around what quality means and what high quality means, and ensuring that there is a rigorous rating process behind that, with technology helping to back up the verifiable aspects of the impact, is going to be crucial to ultimately scale the market. And so an exchange that can provide clear pricing signals, a clear indication of baskets of credits that have similar rating in terms of quality. These are going to be some of the key components that adds to the integrity of the markets and ultimately scalability of the markets.
Thank you. Another interesting question. I mean, there's a few questions around the similar theme, but I think we can put that one to discuss. It's from Noel Coulavaniela from Equilibrium Capital. Basically, it's around the negotiation on COP26, and if not, how can a global framework be put in place for carbon market, and whether voluntary is the right one. And I think it's a little bit controversial because I don't think it's our purpose as a panelist from the private sector to address government negotiation. But I'd like to understand your perspective on whether this is really the role of corporates to voluntarily commit to this, or do you need to actually look at it within the framework of states and global international regulations?
Yeah. I think COP26 would facilitate as they resolve Article 6, which is key. But really, I think leaning towards government and policy as the basis for catalyzing voluntary carbon markets is probably the wrong emphasis. And I think the cap and trading systems that China is trying to implement this year, or the other voluntary carbon markets, I think will catalyze the availability of and the prospects of scaling voluntary carbon markets. So I think we should influence and lean in heavily into COP26, resolving Article 6, which will be a catalyst and a facilitator. But we also have to be cautious that we've had 3 miraculous agreements, global agreements, the Convention on Biodiversity, which was announced in 2010, finished in 2020, 20 strategic goals that 199 countries committed to. We have achieved 4 out of those 20 goals. We have no chance in hell of achieving the UN SDGs, and I'm not trying to be cynical or very pessimistic here, because we're already 5 years into that program, and no country is on the trajectory of achieving the UN SDGs. We have no chance of limiting global temperature to below 1.5 degrees centigrade, right? And again, 195 countries have signed up to it. Yeah. So it is not these grand pronouncements and bold vision and action and what and everything else. It is really about how. How do we get this done? And what are the rewards and penalties for not getting it done? We all understand that it has a huge cost to all of us and our future generations and everything else. That's fine. But COVID, we have spent $27 trillion fiscal and monetary stimuluses across the countries to deal with COVID, because it is an existential threat, tangible, staring us in our face. If you don't take action today, you might die, right? So we are all clear about that. But climate change and all of this stuff is gradual effects, cumulative, distributed dangers over time. Nobody is willing to act today for something that is so far out in the future, or they believe is far out in the future. So if you don't have the clear pathways on how we can take practical steps in reducing carbon footprint, and not just focus only on carbon offsets, but really mitigation and abatement, we have lost this battle already.
Thank you.
More directly, I think it is getting on the COP26 agenda. Part of the initiative builds up initiative working with, I noticed the UK High Commissioner here, working with the UK City of London. We're trying to make sure that some of this is on the agenda, the COP26, the voluntary carbon market agenda. It's not without controversy, because there is a school of thought which says the minute you accept a voluntary carbon market, you take the gun off the head of people to really substantively change their own business models. I'm of the camp that, of course, you need to change your business models, but you've also got to recognize that there's trillions of dollars of extant infrastructure that exists. And so for companies and industries to change overnight is neither practical in the time frame, nor is the money available to do that kind of change. So there will be some industries, steel, transportation, which are going to find residual problems. And therefore, in the hierarchy, as you point out, Herry, having a voluntary carbon market to be able to abate this thing by getting somebody else to sequester is not a bad idea at all. But we need to make sure that there's broad acceptance of that. And I think COP26 will get around to addressing some of that.
Thank you.
Just to add to that, just keeping in mind that COP26 is actually a meeting up of the parties, which are actually nations, right? So we've got many diplomatic community here, Your Excellencies here as well. Keeping in mind, it is actually parties that are meeting up, i.e. the countries. Voluntary carbon market isn't necessarily what's going to be negotiated at the COP26 official events. Having said that, there will be a component of Paris Agreement, which is a very important component that still needs to be patted down, which is on the climate mitigation outcome, transfer mechanisms and the market mechanisms and how that can work between the parties, which very much so is tied to carbon credits again, carbon markets, more on the compliance side or between the parties. But do we think that a voluntary carbon market has a role to play, even when there is increasing, let's say, regulatory or government oversight on the carbon markets in order to scale it? We believe the answer is yes, because again, going back to my very first statement, this cannot be done alone by any one sector, and all levers need to be pulled at this stage. And that's why so important to ensure that there is connectivity as well as integrity in the markets.
Thank you. We are coming to the end of our panel, but just very briefly, I'd like you are thinking of what's next. Carbon is the first externality to be tackled. What about water pollution? What about biodiversity? And you touched a little bit.
Yeah. I think they're all interrelated, but I think the three major crises that we face is the climate emergency and therefore carbon management. But it's also about biodiversity loss and nature collapse. But it's also about systemic poverty and systemic inequality of incomes and wealth and systemic discrimination and all of that stuff. They're all interrelated. We can't see these as separate problems and try and solve for them in silos. We have to try and do that all together. With your permission, I'd just like to ask one question of the audience, right? So you asked us a few questions. My question is, how many of us as CEOs in this room feel really confident that we will achieve our net zero goals by 2050? Or halve our carbon footprint by 2030, can you really say with any confidence that you have a granular pathway, a climate action plan that will get you there? Is your confidence 20%, 30%, 0%, 100%? You don't need to answer now, but please think about that. Because I've asked this question around the globe, and I don't see anybody coming to me with any degree of confidence they'll achieve it. They know what they want to do, but they don't know how they're going to get there.
Thank you, Sunny. Any few words that you want to add to this?
No, I think Sunny sort of nailed it. I think my only other comment is, we have TCFD for climate-related disclosures. There's now work happening on TNFD for nature-related biodiversity disclosures. I think the measurement challenges on biodiversity and nature collapse are even more difficult than on carbon itself. So I think it's a journey that we'll all have to take, and it's going to be slow.
Thank you, Piyush. Herry?
Yes, it's a motto I live by, which is that sustainability is a journey, not a destination. And the end goal will shift as we improve and as we actually get nearer to reaching the goals. So, but the main thing is that we all get started and start to look in the same direction and work with the different parts of the overall ecosystem.
Thank you very much. I think our time comes to an end. And again, thank you for coming here and sharing your insight with us.